Wait, what if I told you that for a few shocking seconds, the silver market practically went dark? And right after that, the price collapsed. No warning headlines, no countdown. Just silence in the order book, and then chaos. If you care about silver, gold, or protecting your money in uncertain times, this is something you cannot ignore. Before we go deeper, take 1 second to like this video and subscribe to Safe Haven Wealth. It truly helps the channel grow and keeps you updated on real market shifts that most people never even hear about. Let's break this down calmly and clearly. Recently, traders watching the CME silver futures market noticed something unusual. The order book, which normally shows layers of buy and sell orders at different price levels, suddenly looked thin, almost empty compared to normal activity. For those new, the CME, or Chicago Mercantile Exchange, is one of the world's largest derivatives exchanges. This is where massive institutions, hedge funds, and professional traders place high-volume bets on commodities like silver. When something strange happens there, it matters globally. The order book is like the heartbeat of a market. It shows how much liquidity exists. In simple words, how easy it is to buy or sell without causing a big price move. Strong liquidity means smooth prices. When liquidity suddenly disappears, even small sell orders can push prices sharply lower. And that's exactly what seemed to happen. Within seconds, selling pressure hit and the price dropped fast. Not gradually, not gently. It felt like the floor disappeared for a moment. Now, here's the key question. Was this manipulation, panic, or just algorithmic trading reacting to something? In today's markets, most trades are not placed by humans clicking buttons. They're executed by algorithms, computer programs designed to react in milliseconds. When volatility spikes or when certain technical levels break, these systems can automatically pull liquidity. That means buy orders vanish. And when buy orders vanish, sellers have no cushion beneath them. This is where silver becomes different from many other assets. Silver futures are heavily traded, but physical silver supply is a different story. Paper contracts can move billions of dollars in seconds. Physical metal moves slowly, in trucks and vaults. When paper markets experience sudden drops, it doesn't always mean physical supply increased. Sometimes it simply means leverage unwound. Think about this carefully. If large traders were over-leveraged and prices began to fall, margin calls could trigger forced selling. Forced selling leads to more price decline. That decline triggers more algorithms. It becomes a chain reaction. For a few seconds, the order book can look almost wiped clean because everyone is stepping back at the same time. What makes this event important is not just the drop itself, but the structure behind it. Over the last few years, silver has been positioned by many investors as a hedge against inflation and currency weakness. When central banks expand money supply, investors often move toward hard assets. The Federal Reserve has played a major role in shaping liquidity conditions worldwide. Rate hikes, rate pauses, policy shifts, all of these impact commodities. But if traders sensed that monetary policy might stay tighter for longer, that alone can pressure metals in the short term. Higher interest rates strengthen the dollar. A stronger dollar often weighs on silver prices. But short-term price collapses don't automatically change long-term fundamentals. And this is where smart investors separate emotion from strategy. Let's zoom out for a moment. Silver is not just a monetary metal. It is also an industrial metal used in solar panels, electronics, electric vehicles, and medical equipment. Global demand trends are still strong. Supply growth, however, has not exploded. That creates a delicate balance. When paper markets shake, physical demand sometimes quietly increases in the background. Many experienced investors don't panic during sudden drops. They ask a different question. Was this structural weakness or temporary liquidity stress? If the order book thinned because algorithms stepped away, that's a liquidity event. If industrial demand collapsed, that's a fundamental event. Those are two very different scenarios. At Safe Haven Wealth, the goal is not to create fear. It's to help you understand how modern markets actually move. The headlines may say silver crash, but behind every move there are layers, leverage, liquidity, policy expectations, and human psychology. Retail investors often see the price after it drops. Institutions see the order flow before it happens. Another factor to consider is positioning. Futures markets regularly publish data showing how many contracts large speculators hold. When positioning becomes crowded on one side, volatility increases. If too many traders are long, it doesn't take much selling to start a cascade. And in today's high-speed environment, cascades happen in seconds. But here's something most people miss. Sharp drops often clear weak hands out of the market. After forced selling ends, the market can stabilize and even recover. That doesn't mean every dip is a buying opportunity. It means context matters. If macro conditions remain supportive for precious metals, temporary collapses can become long-term setups. Now, imagine you're a long-term investor holding physical silver. Does a futures flash drop change your thesis about currency debasement, inflation, or long-term demand? Probably not. But if you're a leveraged trader, that same drop can wipe out your position instantly. This is why understanding risk management is critical. Let's also talk about psychology. When people see the word dark or order book wiped, fear spreads quickly. Social media amplifies it. Screenshots circulate. But experienced traders always ask for data. How long did liquidity vanish? Was it seconds, minutes, or hours? Did volume spike abnormally? Did other metals move the same way? These details matter more than emotional reactions. Silver has always been volatile. It moves faster than gold in both directions. That volatility attracts traders but can scare long-term holders. If you are investing in metals, your time horizon defines your emotional stability. Short-term noise feels loud. Long-term trends move slowly but powerfully. As we move forward, watch three things carefully: interest rate expectations, dollar strength, and physical demand trends. If rates begin to stabilize or fall, metals often find support. If industrial demand continues expanding, that adds another layer of strength beneath the surface. Events like this remind us that markets are not perfectly smooth machines. They are complex systems influenced by algorithms, institutions, and human emotion. A thin order book is not the end of silver. It's a signal that liquidity can vanish faster than most people expect. If you found this breakdown helpful, take a moment to share this video with someone who follows precious metals but may not understand how futures markets work. And I'd love to hear your thoughts. Do you think this was pure liquidity stress or something deeper building beneath the surface? Drop your opinion in the comments. Your perspective helps this community grow stronger and smarter together. Stay calm, stay informed, and remember, real wealth protection is not built on panic, it's built on understanding. This is Safe Haven Wealth, and we will continue bringing you clear, balanced insights so you can navigate uncertainty with confidence.